Hello there. In the Pulse last month, we talked about how inflation seems to now be coming back down to more kind of normal levels. And as a result, we think that interest rates may now have peaked. And in fact, markets have gone even further than that, and they're now starting to price in interest rate cuts, perhaps as early as the first half of next year. Now, if you see the chart on screen, you can see that interest rates have, of course, gone up very, very sharply over the past couple of years. But depending which forecast you believe, interest rates could come back down perhaps as low as 4% or even lower than that by the end of, say, 2025. And of course, interest rates going up so steeply has been one of the reasons why it's been such a difficult time for investors, and that's hit equities and bonds. But over the last few weeks, as those interest rate expectations have come down, that means that some of those assets have rallied and actually done pretty well. And in fact, some of the asset classes that were hit the hardest by rising rates have done the best over that time period. In particular, we've seen UK stocks do very, very well, in particular smaller companies, which again had been hit hard by rising rates. Now, earlier in the year, we asked whether there was something wrong with the UK, whether maybe the UK was doing worse than other comparable countries, and why that might be the case. And certainly for quite a while, it looked like inflation was significantly higher here in the UK. And again, you can see that on the chart on screen, but it's falling very sharply, and we'd expect, looking in the future, that inflation will be back down to similar levels to other regions in the very, very near future. Also, there was a lot of evidence, and certainly the official data had showed that UK economic growth had been pretty weak over the past couple of years. But actually, with some of the revisions to the data, our recovery from the COVID pandemic has actually been better than the likes of Germany and France. So it's perhaps not as bad as some of the data previously suggested. Growth has remained sluggish, but we have avoided the steep recession that many were predicting last year. And we've talked before how we think that certain UK assets look really quite good value, they look quite cheap. And international investors now seem to be starting to recognise that. We've seen a number of stocks recently on the UK market being bought by big international companies, such as Hotel Chocolat, being bid for by Mars at a huge premium to what was the share price. And we've seen similar things amongst some other stocks. In fact, when we look at one of the stocks called Smart Metering Systems, it's in our AIM portfolio, recently got a bid of 40% above the share price. But when we look at what's happened to the earnings of that companies over the last few years, actually it makes perfect sense. The share price might have gone down over the past few years, but the profits have carried on going. And we've seen lots of examples of that, where UK companies have carried on growing profits, but the share price has not recognised the growth potential of the company. And what we've seen now with all these bids from private equity and the like, is people starting to recognise the value out there. And hopefully, if that continues, that could bode well for UK stock markets as a whole, and not just for individual companies. Now, as always, we're always looking at what risks might be around the corner, and whilst we're really optimistic about some of the returns, one thing that could derail things is if those interest rate cuts that people are expecting don't happen. So it will be interesting to watch the data and see what happens there. And it's also worth pointing out that we'd expect inflation to go back up early in the new year. That's for two reasons. One, because January last year was a negative month, so we actually saw deflation in January last year. That will, of course, drop out of the annual figure when we get to January this year, or January 2024 rather. And also in January 2024, we get the next round of energy price revaluation. So the energy price cap goes up, and that's going to go up by about 5%. So we think the negative month from January 2023 will be replaced by a reasonably high month in January 2024. So therefore you will see inflation go back up at the beginning of next year. However, we think that's just a temporary move. I don't think it's a change in trend. I think the overall trend is still that inflation is coming back down to normal levels, and therefore we're really quite optimistic about the returns from the future. So it just remains for me to wish all of our clients and all of our contacts say a very happy New Year and a very happy Christmas, and hopefully we'll have a very prosperous 2024. Thank you.